going back to central banks, I mean, what central banks are doing is not so much buying gold as dumping fiat currencies. That is the adjustment they're doing in their reserves. And I think that is the point which one's got to understand. You've got to look at it from their point of view. Their point of view is actually quite simple. We're holding dollars. Dollars are going down. We don't want dollars. What do you buy? Euros? No. We've got some of those. Sterling? No. Yen? No. We don't want to buy any of those. We've got them. Basically, we see risk in the dollar-based fiat currency system. So we've got to hedge that risk by selling them and moving into real legal money, which is metallic with no counterparty risk, and that's gold. So that's really what they've been doing.
Alasdair Macleod, head of research at Goldmoney and a leading voice in sound money economics, shares an unfiltered breakdown of why central banks are dumping fiat currencies, not just buying gold. It's not about bullish bets on metals, he says. It's a systemic hedge against a failing global currency regime. From the central banker's perspective, the logic is brutally simple. They're holding US dollars, and the dollar is losing purchasing power. But where do they go next? Euro? Yen? Sterling? Nope, says Macleod. The answer is real legal money, gold. It has no counterparty risk, default exposure, or central bank meddling. Macleod lays bare the policies that tried to suppress gold for decades. He cites how gold was leased, dumped into markets, and converted into US treasuries via the carry trade, artificially inflating demand for dollars while manipulating gold prices. At one point, as much as 10,000 to 16,000 tons of central bank gold may have been used for this purpose, possibly a third to half of all declared reserves. He references the 2013 German Bundesbank incident, in which the New York Fed refused immediate access or full repatriation of German gold, a red flag on gold's double ownership and murky custodianship. Why does it take 7 years to send back 300 tons? Macleod asks. Gold, he argues, has retained purchasing power for centuries. The price of essential goods in gold 2,000 years ago isn't different from today. It's not volatile like fiat. It's steady, anchored to human needs and usage, and even expanding at the same rate as a global population. At the core of Macleod's thesis is that fiat credit has no anchor today, and without that gold linkage, the system is spiraling into risk and instability. We present the latest clips of Alasdair Macleod's video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The policy of suppressing gold and trying to drive it out of the system and trying to get everybody to accept that gold is no longer part of the monetary system, but the dollar is king and the dollar has replaced it. That attempt has involved the use of gold being leased, if you like, and then sold into the market, and the proceeds then invested in a carry trade to buy US T-bills. I mean, this was the situation basically in the 80s and 90s. Frank Veneroso, who was a highly respected analyst at that time, looked into this, and he came to a conclusion that anything between 10,000 tons and 16,000 tons of central bank gold had been used for this purpose and sold into the market, and presumably, as I think he put it, was adorning the next wrists of Asian women. In other words, it had gone. Now, the point is that, when you talk about 10 to 16,000 tons of gold, I mean, roughly it's a third to a half of all declared gold reserves at that time, at the year 2000, round about then. After that, I think that the central banks got slightly wiser about it. And you then had what was called a book entry transfer system, so that the Bank of England would say, okay, we're leasing, we have the agreement from, say, the Bank of Finland to lease half their 30 tons of gold stored with us, and we agreed the rate and all the rest of it, but it's not leaving our vaults because it's got to be stored somewhere. So what happened was that the trade moved from carry trade into US T-bills into a carry trade to provide liquidity, the forward market in London and also other derivative markets, including COMEX. And that probably means that instead of gold disappearing, you've now got double ownership of an awful lot of it in central bank vaults, in the Bank of England and also in the Federal Bank of New York. And I mean, I think proof of this problem was when, 10 years ago, 10, 11 years ago, I think it was 2013, actually, the Bundesbank decided, first of all, he wanted to go and inspect its gold at the Federal Bank of New York, and we're told, under no circumstances we will permit anyone look at it. they then tried to get their gold back. And obviously negotiations took place, which we weren't a party to. And they ended up agreeing, very reluctantly, I would think, to having 300 tons of their, I don't know how much, 1,000 tons or whatever it was, returned over a 7-year period, would you believe? Why is it so difficult to do this? And this was so embarrassing, actually, for the New York Fed, that eventually they actually sent the whole lot back several months after this 7-year agreement was.
Alasdair Macleod doesn't mince words. Today's financial system is broken, and gold is the only anchor left. Without a gold standard, credit floats without value. It's not just risky, it's dangerous. He explains that central banks aren't just sitting on gold. They're reluctant to let it go. Why? Because they know its real worth. In past decades, central banks freely leased gold into markets to suppress prices and boost fiat illusions. But now, the tide has turned. Instead of leasing, they're hoarding. Instead of trusting paper, they're turning back to metal. Even gold leasing has evolved. What used to be physical outflows became book entry transfers, where gold stayed in vaults but was simultaneously claimed by multiple entities. The result? Double ownership and shaky claims. When Germany tried to repatriate gold from the US, it faced delays and secrecy. A red flag that not all that glitters is indeed accounted for. Macleod's message is clear. Central banks know the storm is coming, and they're quietly preparing for it, not with crypto or bonds, but with the oldest money in history. Let's get back to the interview.
And I think the thing to understand about gold is its purchasing power obviously fluctuates, but it doesn't fluctuate by very much. Certainly not as much as the purchasing power of a fiat currency. And if you look at, prices, say 2,000 years ago, for many of the common goods that we need, and as humans, you'll find that the prices in gold are actually quite similar to the prices today. So, this is, if you like, I'm not saying that gold is a sort of wonderful, beautiful, and it's absolutely steady and there's no variation in its purchasing power whatsoever. But what I'm saying is that taking everything into consideration, it maintains its purchasing power over a long period of time. And if you look at estimates of above ground gold stock and how that has been increasing, it increases at roughly the same rate as the world population. So in other words, the human users of gold, not that they use gold, so, we can come on to that in a second. The human users of gold basically find that, gold is expanding at roughly the same rate as the population, and therefore there is a constancy in that. They don't actually use gold, they use credit. And this is a point which nobody seems to understand. What do we do with gold? I mean, we have gold coins, maybe, we might even have bullion. But if you look at in terms of coinage, then gold coins and silver coins are not the thing you use first to pay for goods and services. No, it's the last thing. Gresham's law basically says that the bad money drives out the good. What's happening is that you spend the credit, if you like, which even on a gold standard is based on gold. It's linked to gold. And if you're worried about the value of that credit, then you encash it for gold coin. That's the way a gold standard works. And I think, I really find it, complete. It's just completely understandable that what's happening without any anchor, credit has no anchor to gold at all at the moment, that there is just huge risk in the whole system. And that is now coming true in the form of debt traps, in the form of government response to the necessary response, if you like, to any economic crisis, increased unemployment, whatever. They're just going to debase it further. The only solution to this is to go back onto a gold standard. And the way to look at it is that, a mechanism has to be put in place whereby credit, the value of credit is securely tied to gold. And if it's not securely tied, then it's not good enough. It's desperately important that what we have today, which is failing, is replaced with something which is absolutely cast down. We know how to do it, or at least those of us who have studied the faults, if you like, of the Bank Charter Act in England of 1844. We know how to do it. It's actually not all that difficult. All this rubbish about there's not enough gold and all the rest of it, which the Keynesians talk about, basically means they don't understand credit. You've got to tie the value of credit. Now, the problem we have, I think, is that the people advising the system, if you like, don't understand economics. They think in terms of neo-Keynesian economics. They have to get off this ridiculous idea that gold is not money. Legally, it is money and has been since Roman times. Since the 12 tables in Rome, 448 BC, declared the difference between money and credit. Tablet 7. It's all in there. You can Google it and have a look, and it's there. And it's been like that ever since. The Romans invented banking system, which we've refined, and we still have. So, in terms of resetting, as it were, there are so many hurdles to come over. And the other thing is, I think central banks are now very reluctant to let gold go. So the idea that a central bank will actually come up with a proper gold exchange for credit standard, is actually quite hard to envisage because of their attitude. They've got the gold reserves and they don't want to part with it. They would rather have some sort of, if you like, fancy idea about, giving people the confidence that we've got enough gold to back currency without actually having to back it, sort of thing.
In closing, AlasdairMacleod calls for a return to real money. The only proper solution, he says, is a gold-backed credit system, one where currency has meaning and trust is grounded in tangible value. Today's fiat system, governed by neo-Keynesian thinking, lacks that foundation. Central banks may pretend gold is obsolete, but their actions tell a different story. They hoard it, hide it, and refuse to part with it. Why? Because gold is money. It has been since Rome and still is today. The idea that there's not enough gold to back credit is a myth. The real problem is that policymakers don't understand credit or are willfully ignoring it. Macleod's warning is blunt. Without tying credit securely to gold, the system is doomed to repeat the same cycles of crisis, debt, and debasement. Want to stay ahead of the monetary reset? Share your thoughts on Alasdair Macleod's analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.